Welcome to the deep dive. If you're trying to get a handle on retirement finances, you've probably heard about annuities.
Yeah, they definitely pop up a lot in retirement planning discussions.
Exactly. So today we're digging into what are annuities and how can they secure your retirement? That's our source, our mission. Really just to, understand the fundamentals here, cut through some of the noise.
Sounds good, because people want that steady income into retirement, right?
Yeah.
And this source positions annuities as one potential tool for that. Basically, you invest now,
For payments later?
right, for payments later. The idea is achieving, well, some financial peace of mind.
Okay, so let's start super basic. In a nutshell, what is an annuity?
Um, think of it like a contract you make with an insurance company. You give them money,
A premium, usually.
yeah, a premium or a lump sum, and in return, they promise to pay you back over time, like a stream of income.
Got it. Now, the source mentions different types. This is where it can get a bit confusing, maybe.
It can seem that way, but we can break it down. First up, you've got fixed annuities. These are pretty straightforward.
How so?
Well, they guarantee a specific interest rate, so your payments are consistent, predictable. If stability is your main goal,
That's the one to look at? Okay.
what's next? Then there are variable annuities.
Mm.
Here, things are different. Your money gets invested in options linked to the market, like mutual funds.
So there's potential for your money to grow more.
Exactly. Higher potential returns. But, and this is key, it also comes with market risk. Your payout could fluctuate based on how those investments do.
Okay, so fixed is steady, variable has growth potential, but risk. Is there something in between?
There is, yeah. Index annuities. They sort of try to bridge that gap. Your returns are tied to a market index, maybe like the S&P 500.
But with some safety net.
Right. Often, they offer protections for your principal investment, so you won't lose your initial amount, but there might be caps on the upside.
Interesting. And you mentioned timing, too. Immediate versus deferred.
Yep. Immediate annuities, as the name suggests, start paying out pretty much right after you buy them, maybe within a year.
So quick income.
Quick income, yeah. Deferred annuities, on the other hand, have a waiting period. Your money grows for a while, could be years before you start receiving payments.
Okay, that's a helpful overview of the types. Fixed, variable, indexed, and then immediate or deferred timing.
That covers the main categories, yes.
So how does the actual mechanism work? You give them money. How does that turn into income later?
The core idea is converting that premium, that lump sum, into a stream of payments. How much you get and for how long. Well, it depends
Depends on what factors.
on the type of annuity you chose, naturally. How much money you put in initially, your age when the payments start is also a big factor, and the specific payout options in the contract.
Right, payout odds like payments for life or for a set number of years.
Exactly, those kinds of things. Now, with deferred annuities, you mentioned those phases, accumulation and annuitization.
Yeah, what's the deal with those?
Okay, so the accumulation phase is simply the growth period for deferred annuity. Your investment sits there and hopefully grows. This can last anywhere from, say, 5 years up to maybe 30 years.
And the big advantage here is
Tax deferral. The growth isn't taxed year after year like interest on a CD might be. It compounds without taxes taking a bite until you withdraw it.
okay, so potential for faster growth because of the tax deferral. Then what's annuitization?
Annuitization is just the point when you flip the switch, basically. You start receiving those regular income payments you planned for.
And that's when the tax man comes calling.
That's generally when the income becomes taxable, yes. At least the earnings portion. Immediate annuities, remember, they skip that whole accumulation phase. You buy it, payments start soon after.
Got it. Deferred, grow first, tax deferred, then payout, taxable. Immediate, payout quickly. The source also mentioned risk transfer. That sounds important.
It really is. A key function of annuities is shifting certain risks from you to the insurance company.
Like what kind of risks?
Two main ones. Market risk, especially with fixed or indexed types. The company absorbs much of the investment volatility risk. And longevity risk.
Longevity risk, the risk of living too long. Sounds like a good problem.
Well, financially speaking, it's the risk of outliving your savings. An annuity, especially one with lifetime payments, protects against that. The insurance company guarantees the payments for life, no matter how long that is.
Okay, that is significant peace of mind. But insurance companies aren't charities. How do they cover this?
Fees. Definitely fees. They charge for taking on that risk.
Yeah.
You'll see investment management fees, especially in variable annuities. Fees for riders, as those optional extra features or guarantees.
Yeah.
And general administrative service fees, too.
Right? I need to factor those costs in. And one more thing, surrender periods. You can't just cash out whenever you want.
Generally, no. Not without potential penalties. Most annuities have a surrender period, often several years long. If you pull your money out early during that period,
You get hit with charges.
exactly,
Yeah.
surrender charges. And they can be pretty steep, especially in the early years, which would reduce your effective return. It's designed for long-term planning.
Okay, so summing up, we've got the basic definition, the types fixed, variable, indexed, immediate, deferred. We understand the accumulation and annuitization phases for deferred ones.
The tax-deferred growth potential.
Right. And the risk transfer market and longevity going to the insurer, paid for by fees. Plus, those surrender periods, locking your money in for a time.
That covers the core concepts from the source pretty well, I think. You can see how it fits into the retirement income puzzle. It's a tool for creating predictability.
Definitely. So maybe the final thought for our listeners is this. Considering everything we've talked about, stability, growth potential, immediate income needs, fees, access to funds, what resonates most with your retirement goals?
Which aspect is most critical for you? Is it the guaranteed income floor from a fixed annuity, the potential upside with risk of a variable one, or maybe needing income right away?
Thinking about that and how these different features align with your own financial situation and, importantly, your comfort level with risk, that seems like the crucial next step if you're considering annuities.
Absolutely. It's about matching the product to your individual needs.
Thanks for joining us for this deep dive.